Hey everyone, welcome back to the Deep Dive.
Hey there.
Today we are cracking open the Ramaco Resources, Inc. First Quarter 2025 Results Conference Call.
Yeah, getting into the details.
Think of this as your shortcut to understanding, exactly what happened, what the company's highlighting, and what they're thinking about the future, straight from their words.
That's right. And this call, it really presented two very different sides of the company's story.
How so?
Well, on one hand, navigating some pretty tough near-term market conditions in their core coal business.
Okay.
But then simultaneously pushing forward on this completely separate, potentially transformative long-term project. So it's a complex picture, but definitely worth unpacking.
Okay, let's jump right in then.
Yeah.
The headline numbers for Q1 2025, they definitely show the impact of those tough conditions you mentioned. Adjusted EBITDA came in at $10 million. That's a significant drop from $29 million in the previous quarter, Q4 2024.
Yeah, quite a slide. And that flowed right through to the bottom line, too.
A net loss of $9 million for the quarter. Compare that to net income of $4 million in Q4.
Wow.
And Class A EPS, earnings per share, reflected this too. A loss of $0.19 per share versus a $1.06 gain in the prior quarter.
So what were the main culprits for that sequential decline? What did they point to?
The company highlighted two primary factors. First, a $7 per ton sequential decline in their realized pricing. That's, the actual price they got for their coal.
Okay, lower prices.
And second, a 175,000 ton decline in the volume of coal they actually sold compared to Q4.
So lower prices and lower volume, that's a tough combo.
It hit them hard quarter over quarter, definitely.
Right, those are the top line impacts. But here's where it gets kind of interesting on the operations side. Despite those challenges, they actually managed to achieve record quarterly production.
That's right, annualizing to a rate of 4 million tons per year.
Which is pretty impressive given everything.
It really is. And on the cost side, their cash costs for sales came in at $98 per ton.
Okay, $98. What's the significance there?
Well, it's the second straight quarter they've been under $100 a ton.
Ah, okay.
And that firmly positions them in the first quartile of the U.S. metallurgical coal cost curve.
Being in the first quartile. What does that really mean in practice for them, especially now?
It means they are among the absolute lowest cost producers of met coal in the whole country.
Right.
In a market where prices are falling, like now, having costs this low is just a fundamental competitive advantage. It's what allows them to potentially stay profitable or, at least minimize losses when maybe others are struggling with negative margins.
Absolutely crucial in this environment. Okay, so let's dig a little deeper into the details behind these numbers and their forward view. On the financial and operational side, they talked more about those weather issues that hit them in Q1.
Yeah, they specifically called out two distinct periods. There were 2 weeks of freezing temperatures back in January.
Right.
And then that historic flooding in February. You probably remember seeing some of that. It's pretty disruptive across the board.
And the impact on their business specifically, what did they quantify?
They said those weather events negatively impacted their quarterly production by roughly 150,000 tons.
Okay.
So even with that record run rate you mentioned earlier, the weather still took a bite out of what they could have produced.
And it hit costs too.
Yeah, it also contributed to a slight uptick in their mine operating cash costs compared to Q4, just, lower volume spreading those fixed costs over fewer tons.
Gotcha. They also made a conscious decision about sales strategy during this weak period, right? Something about inventory.
That's right. They decided to build inventory instead of pushing tons out.
So holding back supply.
Exactly. It was a deliberate choice, they said, to avoid forcing sales into a really challenging spot market where prices were depressed. The idea is hold it, get a better return later when conditions hopefully improve. It hits current revenue, obviously, but it's a strategic inventory management play.
Makes sense. Now, despite all this market weakness and the weather hits, they did highlight something that really stood out to me.
What was that?
They reported having both the highest cash margins per ton and the highest realized sales price among their publicly traded peers during the quarter.
That is quite telling, isn't it? It speaks to that strong cost structure we just talked about.
Yeah.
And probably reflects their specific customer contracts or maybe the quality of their particular coal grades. Even while facing the same broad market downturn as everyone else, they managed to capture better margins and prices than competitors. And they even noted some competitors were reporting negative margins.
So, relatively speaking, they're managing the current environment pretty effectively. Looking ahead then, they adjusted their 2025 guidance in several areas.
Yes, quite a few tweaks. On cost, They actually slightly lowered their full-year cash cost per ton sold guidance. It's now $96 to $102, down from $97 to $103 previously.
Okay, a slight improvement there. What about spending?
CapEx, capital expenditure, or CapEx guidance was reduced. Now $55 to $65 million, down from $60 to $70 million.
And they mentioned why.
Yeah, they specifically noted deferring the Berwind fourth section growth project for now.
Got it. How is that remaining CapEx split out, roughly?
The breakdown is around $10 per ton for just maintenance capital, keeping things running. Then about $15 million dedicated to growth projects.
Okay.
And about $5 million allocated specifically to that critical rare earths project we'll talk more about later. They also noted most of that growth CapEx is front-loaded, happening in the first half of 2025.
All right. Production and sales guidance for the full year, those came down slightly as well, I believe?
They did. Full-year production guidance is now 3.9 to 4.3 million tons. That's reduced from 4.2 to 4.6 million.
Okay.
And full-year sales guidance is 4.1 to 4.5 million tons, down from 4.4 to 4.8 million.
What's the thinking behind those lower volume projections for the year?
They explained it's part of that strategy we mentioned, optimizing sales in this weak market. It's really designed to limit potential sales at lower spot prices.
Being selective.
Exactly. Which ultimately helps enhance free cash flow by being more choosy about when and at what price they sell their tonnage.
Makes sense. Any other guidance changes? SG&A.
Cash SG&A, yeah. Selling, general, and administrative costs that went up a bit to $36.40 million from $34.38 million.
Why the increase there?
They attribute it largely to increased legal expenses. Apparently, they have a lawsuit against Chubb Insurance going to trial this summer, and that's, bumping up their overhead costs.
Oh, okay.
Depreciation, depletion, and amortization, or DD&A. Guidance declined slightly, though, down to $76 million, which just reflects the changes in production and CapEx forecasts.
And for the immediate next quarter, Q2 2025, what are they projecting? What should we expect?
They anticipate tons sold will be pretty similar to Q1 levels, somewhere in the range of 850,000 to 950,000 tons.
Okay, flat quarter on quarter for volume.
But they expect Q2 cash mining costs will be towards the high end of their annual guided range.
And why would costs be higher per ton in Q2 if volume is similar to Q1?
Primarily because of that expected lower tonnage volume relative to their potential capacity, or maybe compared to later quarters. Unit costs tend to go up when you're spreading fixed mining costs over fewer tons.
Right, the denominator effect.
Exactly. It's more a function of the lower sales volume impacting the per ton calculation, not necessarily that their absolute dollar costs are skyrocketing.
Okay, so they're managing costs and volume strategically in a tough market. How's the balance sheet looking through all this? Are they holding up financially?
Their balance sheet actually appears quite solid. Liquidity, basically cash and available credit, was $118 million as of March 31st.
Okay.
And that's actually up almost 25% year over year, which is pretty notable given how tough the market has been.
Yeah, that is strong. What about debt?
Their net debt to adjusted EBITDA was less than 0.7 times on a trailing 12-month basis.
Less than 0.7 times net debt to EBITDA. That sounds very low, especially for a coal company.
It is. It's a very low leverage ratio for a company in a cyclical industry like this. It indicates they have very little debt relative to their earnings power, even their current depressed earnings power.
So that gives them breathing room.
Absolutely.
Yeah.
This strong financial position is crucial. It allows them to withstand continued near-term market weakness without facing, financial distress.
Okay, good context. Switching gears now, let's talk about the broader market dynamics for coking coal. What picture did they paint there? Still challenging.
It's still generally weak globally. Index averages were down about 6% since the start of Q1.
Okay.
The Australian Premium Low Vol Index, that's a key benchmark, was around $190.50 a ton at the time of the call, though it had seen a bit of a bounce from lows of 166 cents back in late March.
And the U.S. benchmark?
The U.S. East Coast Low Vol Index was similar, around $181, also up about 4% from its recent low point.
What caused that little price bump we saw recently in Australia and the U.S. East Coast, did they say?
They attributed the Australian rise largely to supply disruptions and maybe some restocking demand, but they emphasize it's not being driven by stronger underlying world demand for steel.
So more temporary factors.
Seems like it. More related to those temporary issues than a fundamental market shift upwards.
And how do they see the U.S. market specifically? Are the indices telling the whole story?
They feel the current Atlantic Basin indices might not be fully capturing the supply side impacts happening right here domestically.
Like what?
They pointed to recent bankruptcies, mine idlings, staffing reductions, stuff happening throughout the U.S. metallurgical coal space. They expect this trend of supply contraction to continue, particularly in their core operating region, the Central Appalachian markets.
So supply is coming off the market. What's driving all this pressure on the market globally, though? Why are prices still weak if supply is shrinking?
The main culprit, they said, is persistently weak steel mill profitability, especially in markets that export a lot of steel.
Ah, the steel connection.
Right. And the continued strong pace of Chinese steel exports is creating downward pressure on global steel prices and margins everywhere else. If steel mills aren't making much money, they're just less willing or able to pay high prices for met coal, which is a key input for them.
And trade tensions don't help.
Yeah. Exactly. Global tariff disputes are also adding another layer of uncertainty to everything.
It sounds like this is causing some real stress across the industry.
It definitely is. They noted these conditions are taking a visible toll, particularly on the smaller, maybe less well-capitalized producers.
Right.
And also those who relied really heavily on exporting coal to China, a trade that's been severely impacted by tariffs and restrictions over the last few years.
So where are we in this cycle, according to them?
They expressed the view that we're likely, maybe, at the midpoint of this correction, and that further supply cuts will probably be needed from various producers to help bring the market back into balance.
Okay. How's the demand side looking, beyond just China's steel exports impacting global prices?
Chinese seaborne demand for met coal remains pretty subdued, largely because they have ample domestic supply. Plus, they're getting a lot from Mongolia and Russia, which is displacing international tons coming in by sea.
Any bright spots on demand?
The one bright spot they noted is growing demand from India. That's partially offsetting some of the weakness elsewhere.
Okay.
They did also say seasonal restocking patterns might bring some near-term softness before any broader recovery really takes hold.
Are there any potential positive catalysts they see on the horizon for the market? Anything that could turn things around faster?
Yes, they mentioned the rumored Chinese steel production cuts. This is interesting.
How would that help? Wouldn't less steel production mean less coal demand?
Well, yes, initially it could dampen near-term met coal demand slightly, but critically, the bigger effect would be reducing the volume of Chinese steel exports flooding the global market.
Ah, okay, so it helps steel prices outside China.
Exactly. Lower Chinese steel exports could help stabilize global steel prices and margins for mills outside China. And that could in turn accelerate a recovery in metallurgical coal demand and prices in places like Europe and the Americas.
Interesting dynamic. Looking longer term, they sounded a bit more optimistic about the European steel market specifically.
They did. They see policymakers in Europe pivoting towards more expansionary growth strategies.
Like what?
Things like increased infrastructure spending, manufacturing incentives, maybe potential safeguard actions against low-cost steel imports.
And the argument is?
The argument is that this should drive downstream demand for steel within Europe, help bolster steel mill margins there, and lay a stronger foundation for sustained metallurgical coal consumption in the Atlantic Basin.
And their specific coal fits well there.
Yeah. They also specifically mentioned that Ramo's particular coal grades remain in high demand with their specialty customers in Europe, so they feel well positioned if that market strengthens.
Okay. And what about South American markets?
They describe them as pretty stable right now, with maybe modest upside expected in the back half of the year. Their existing contracts in that region are performing well, and they're taking a pragmatic, cautious approach to handling spot inquiries, given the current lower prices. Don't want to lock in too much at the bottom.
Right, makes sense. Okay, so that's the picture of the core met coal business, strong operations, managing costs and volumes strategically through a weak market, and watching for potential catalysts and longer-term recovery.
Pretty much sums it up.
But a huge part of this call, and clearly a major focus for the company now, is their growth optionality, particularly this critical minerals project.
Absolutely, huge focus. But first, just quickly on the met coal side itself, they did reiterate they retain the ability to increase production relatively quickly if market conditions improve significantly.
How quickly?
They believe they could exit the year producing at an annualized run rate above 5 million tons per annum if the demand and prices warranted making that move. So the capacity's there.
And there's even larger expansion potential longer term they talked about.
Yes, they highlighted the ability to eventually bring on an additional 2 million tons of new production when they see more, longer term clarity in the market.
Where would that come from?
This includes a big 1.5 million ton deep mine expansion at their Maven Low Vol complex and continuing development into the Berwyn #3 and #4 sections, which could add another 500,000 tons combined.
And the timeline and the cost for that bigger expansion?
They estimate that total 2 million ton expansion would take roughly 24 to 36 months from when they give it the green light and cost about $100 million in growth capex spread over those 2 to 3 years.
They mentioned some specific operational improvements recently that support these growth plans too.
Yeah, a couple of things. At the Berwyn complex, they've completed and activated a new ventilation shaft. Now that sounds technical.
Yeah, what does that mean practically?
It's important because it allows quicker access and starting of those #3 and #4 super sections when they decide the market is right to proceed. It removed a bottleneck.
Okay.
They've also seen improvements in the geologic conditions on their existing #1 and #2 sections at Berwyn, which is apparently already translating to higher production rates and lower costs today.
Oh, interesting.
And moving one of those sections back onto reserve they own outright also eliminates royalty payments, providing immediate cost savings on that specific production. Little wins adding up.
And at the Maven complex, any improvements there?
Yeah, they're working with their rail partner on designing a potential batch loadout facility.
A batch loadout, meaning faster loading.
Faster loading. But the bigger impact is it would significantly reduce or maybe even eliminate trucking the coal from the mine to the rail line, which is a major cost component.
Ah, logistics savings.
Exactly. By cutting down on trucking, this would allow the Maven mine to fully realize its potential first quartile cost profile by slashing those logistics expenses.
So putting all that together, they have considerable growth potential within met coal itself that they can tap into when the time is right.
That's right. They specifically noted that over 2 million tons of high-quality, low-cost, low-vol tonnage could potentially be brought online within maybe 12 to 18 months if conditions are right. That comes from the Berwyn growth plus that new Maven underground complex potential. That's significant optionality to have waiting in the wings.
One interesting side point they made was about the labor market easing. How has the current market weakness actually been a positive for them there?
Yeah, it's a bit counterintuitive, but the tightness in the labor market, which was a big problem for a while, has definitely eased up a bit in this current downturn.
So easier to hire.
Exactly. This has allowed Romo to successfully hire and improve the overall experience level of their teams. They mentioned bringing in key talent in safety, operations, and engineering. Having a stronger, more experienced team is a critical asset, especially if they want to ramp up quickly when the market eventually recovers.
Good point. Okay, let's pivot now to the critical minerals project at the brick mine. This seems like the other major pillar of their story, maybe even the more exciting one right now. They certainly sounded very encouraged about the progress.
They did, yeah. The tone was definitely enthusiastic. They described the deposit itself in quite exciting terms, calling it a major domestic rare earth deposit of exceptional size and quality.
And what makes it unique?
A key aspect they highlighted is that the critical minerals are commingled with coal and the adjoining rock strata. And importantly, the deposit apparently has little to no radioactive character, which can be a real challenge and cost driver with some other rare earth deposits globally.
This project has a strong national security angle too, doesn't it? That came through loud and clear.
Absolutely. It's framed very much as a Team USA project, as they put it.
Meaning?
The goal is for it to be 100% mined and refined right here in the USA, directly addressing what they see as an acute national strategic supply shortfall of critical minerals, especially the ones most needed domestically, which they believe this deposit contains.
And they backed this up with a big announcement about a new senior management team addition specifically for this project.
Yes, big hire. Mike Wolochuk has joined as Executive Vice President. His job is basically to oversee the entire project life cycle, from development and construction through to operation and the day-to-day commercial activities.
Where did he come from?
He comes from Fluor Corporation's Critical Mineral Division, has over 30 years of global experience in this space. Ramo clearly sees his move as a strong validation, an indication of his confidence in the project's potential.
This move and the project itself, it ties directly into those recent China export bans we've heard about, right?
That's a key connection they made, absolutely. Just last month, China added terbium, dysprosium, and scandium to existing export restrictions on elements like gallium and germanium.
And Ramo has those.
By what seems like fortunate timing or good geology, These specific rare earth elements and critical minerals, along with neodymium and praseodymium, often called NdPr, are the very ones anticipated to make up over 95% of the expected revenue and cash flow from the Brook Mine project.
Wow.
And these elements, they estimate, represent about 40% of the overall deposit volume. So they're concentrated in the high-value, strategically sensitive stuff.
So they're essentially focusing on the exact elements that are becoming strategically sensitive due to China's actions. And they highlighted the Brook Mine's unique position for some of these specifically.
Yes, according to Fluor, who's doing work for them, the Brook Mine is projected to be the only primary source mine globally for germanium, gallium, and scandium.
The only one.
Globally. That's what they stated Fluor projects. If true, that would be a truly remarkable strategic advantage in a world laser-focused on diversifying critical supply chains away from China.
Okay, that's huge potential. They also gave an update on the testing progress, but mentioned some delays there.
They have. They've completed most of the secondary round of third-party testing, things like geological analysis, chemical work, and hydrometallurgical testing.
Hydrometallurgical.
Yeah, basically using liquids and chemical processes to extract the desired metals from the ore, or in this case, the carbon ore material.
And the delays.
The delays they've experienced were pretty significant, primarily due to massive backlogs at the specialized labs needed for this kind of analysis. They mentioned waiting over a year for results that were initially promised in just 2 months.
Ouch. A year wait.
Yeah, and this lab backlog, they said, is the direct reason why the preliminary economic analysis, the PEA, from Fluor, has been delayed. It's now expected by the end of June.
Okay, so the PEA is coming soon. Despite that delay, did they share any key findings from the technical work done so far?
Yes, they shared some highlights from an updated technical exploration report by a group called WAYAR.
Yeah.
The high end of the estimated total rare earth oxide, or TREO, within the deposit is now estimated at a massive 1.7 million tons.
1.7 million tons. That sounds like a lot.
It's a very large number in the rare earth world. And this figure includes those banned critical minerals like scandium, germanium, and gallium, which they estimate constitute roughly 300,000 tons, or about 17% of that total deposit.
What about the concentration, the grade?
The average concentration grade within the mineralized material on an ash basis is estimated between 450 and 570 ppm, that's parts per million, a standard measure of concentration.
Okay.
They also noted much higher maximum grades found in specific samples, ranging from 3,300 up to 9,600 ppm. So pockets of much richer material.
And what about recovery rates? It's one thing to have it in the ground, another to get it out efficiently.
Crucial point. Based on independent conventional testing by Hazen Research and Fluor, recovery rates for the rare earth elements are reported to be above 80%.
Is that good?
They view this as strong at the current conceptual testing level. Of course, they plan continuous testing to optimize these rates further. They're also exploring novel, maybe unconventional techniques with third parties and the National Energy Technology Laboratory, NETL.
But over 80% sounds promising at this stage.
It is promising. But, scaling laboratory results, especially for a complex mix of elements to a full commercial plant, and achieving consistent recovery rates for all the target elements, especially those at lower concentrations, is a significant technical challenge. They'll need to demonstrate they can manage that effectively during the pilot phase and beyond.
They also clarified the difference between the current lab testing and the planned pilot plant, right?
Yeah, good distinction. Current testing is really small scale, dealing with kilogram-size samples. Think of it like testing a complex recipe with just a few spoonfuls of ingredients.
Okay.
The pilot plant, which is the next major step, will test tonnage-sized samples. That's like making a whole big batch of the recipe in a small version of the final factory.
Why is that so important?
It's essential for getting much more reliable data on how the process actually works at a larger scale, especially for optimizing the recovery of all those different elements, some of which are present at pretty low concentrations overall. It de-risks the move to commercial scale.
Okay, so based on all this testing and their deposit estimates, what does this mean for projected production numbers from the Brook Mine once it's running?
Based on mining roughly 2.5 million tons per year of what they call carbon ore, that mix of coal and mineralized material.
Right.
They project annual critical mineral oxide production of approximately 1,300 metric tons.
1,400 tons. How does that compare to U.S. consumption?
For perspective, the U.S. consumes roughly 10,000 metric tons of total rare earth elements annually. So it's a significant chunk, but not the whole picture.
And is that 1,400 tons all the high-value stuff?
No, they broke it down further. Of that 1,400 tons, they estimate about 560 metric tons, or roughly 40%, will be purified oxides of those 7 key high-value elements we talked about, and PR, DI, key, TB, SE.
The ones driving the economics.
Exactly. Those are expected to drive over 95% of the project's revenue and cash flow. The remaining balance, about 840 tons, will be 11 additional rare earth elements that contribute less than 5% of the revenue. So the focus is very clearly on those specific, high-value, strategically important elements.
Okay. What's the timeline they laid out to actually get this project going? It sounds like they're moving fast.
They are. They expect that PEA with the independent economics and CapEx figures from Fluor by the end of June. And they plan to host a separate call specifically to discuss those details once it's out.
But they're not waiting for the PEA to start work.
No, they stated they feel sufficiently confident in the project's potential to proceed now. They intend to initiate large-scale mining at the Brook Mine site in June 2025, like this month.
Wow, starting mining already.
Yeah, it's a significant milestone. They highlighted it as potentially the first new U.S. rare earth mine in over 70 years and the first new Wyoming coal mine in over 50 years. Big deal for the region.
Are they marking the occasion?
They're planning a formal ribbon-cutting ceremony in mid-July with state and federal officials attending.
Let's talk about that carbon ore concept you mentioned again, mining 2.5 million tons, but only processing a fraction for the rare earths. What happens to the rest of that material?
This is a really interesting and potentially very advantageous part of their model. The remaining roughly 2 million tons per year of non-mineralized coal from the mine.
Just regular coal.
Just regular Powder River Basin thermal coal. It will be sold as thermal coal into the utility markets.
And the impact.
The revenue from selling that thermal coal helps lower the overall cost basis for the rare earth mining operation itself. They emphasize this creates a very low mine cost basis, specifically for the critical minerals, making the economics potentially much more attractive than a standalone rare earth mine that doesn't have this byproduct credit.
So the coal basically acts as a valuable byproduct that subsidizes the cost of extracting the critical minerals. That's clever.
It seems like a distinct advantage, yes.
Okay, so mining starts now. What's the next step on the processing side after that? Getting the minerals out.
Construction of the pilot plant demonstration facility is slated to begin later this summer,
Okay.
with initial operation targeted for 2026. They plan to run that pilot plant for roughly a year, producing concentrate.
And the purpose of the pilot?
The data and experience gained from operating the pilot will be absolutely crucial for informing the final design and the operational flow sheet for the full commercial scale plant. Working out the kinks.
And the timeline for that full-scale commercial plant. When could they be producing finished oxides?
Construction for the big plant is currently slated to commence in late 2026 or maybe early 2027, with the goal of producing commercial-grade mineral oxides by 2028.
Okay, so still a few years out for a commercial product. How are they funding all these initial development steps? The mine opening, the pilot plant?
The capital expenditure for opening the mine and constructing the pilot plant is apparently included within their current 2025 budget.
Okay.
And they also highlighted that they secured a $6.1 million matching grant from the Wyoming Energy Authority, specifically for the pilot plant development over 2025 and 2026. That helps.
And for the much larger commercial plant build-out later, where's that money coming from?
Good question. They plan to assess the optimal capital structure and financial options after the PEA is released in June, as that will provide the detailed cost estimates needed for that planning.
Are they looking for partners? Joint ventures?
Critically, the company stated its intention is to finance the project itself, either directly or maybe through offshoots. They explicitly said they are not currently seeking a joint venture partner for the project itself.
Interesting. Going it alone.
Though they are leveraging development partners like Fluor, Weir, and NetTL for the technical expertise and design work. So, not entirely alone, but maintaining control.
They also announced a pretty significant addition to their board relevant to this project's profile.
Yes, very high profile. Former U.S. Senator Joe Manchin was appointed to the board last month.
That's a big name in energy and policy circles.
Absolutely. His background brings decades of national leadership experience, particularly in energy policy, economic development, the U.S. coal industry, national defense, and, importantly, critical mineral supply chains. Ramo clearly views his addition as bringing unparalleled strategic perspective, which is highly relevant for a project with such significant national implications.
Okay, so putting it all together, they clearly conveyed a lot of excitement about this dual path forward met coal and critical minerals.
Yeah, they feel they are uniquely positioned and ready to grow into being both a strong metallurgical coal company and a significant domestic critical mineral producer. It's an ambitious plan.
The analyst Q&A session offered a few more little insights into some of these areas as well. Analysts asked about sales volume expectations for the rest of the year, right?
They did. The company basically confirmed that their guidance implies a pickup in sales volumes in the second half of the year. Q3, for instance, could potentially reach 1 million to 1.1 million tons, which will be up from Q1 and the Q2 projection.
And how does their domestic contract price factor into their realized price overall? They have one fixed price contract, don't they?
Yeah, they have a domestic contract price of $152 per ton fixed for the year, which is helpful. Definitely helps offset some of the lower spot export prices they're seeing right now.
But it's not the majority of their sales.
No. The analyst confirmed, and the company acknowledged, that the bulk of their tonnage in Q2 and the second half of the year will still be exposed to the volatility of the global indices. So that $152 provides a base, but doesn't shield everything.
And analysts also asked about the potential impact of those recent executive orders that might classify met coal itself as a critical mineral. Any benefit there?
The company sees the primary immediate benefit of that designation, if it sticks, being mainly on the permitting side.
How so?
Particularly for projects on Bureau of Land Management, BLM lands. It could potentially help to fast-track permitting processes.
But no government money coming their way for met coal.
They don't anticipate receiving direct federal funding specifically for met coal anytime soon, based on that. But they do believe the critical mineral designation is a positive long-term recognition that could eventually lead to future policy nuances benefiting the industry. It's helpful, but not a magic bullet right now.
Got it. Regarding the PEA for the critical minerals project, they reaffirmed the end of June target despite those lab delays.
They did. They seem confident it'll be ready. They noted that while the preliminary numbers in the PEA will likely include some conservatism and contingency factors built in.
Standard practice.
Right. It will still provide investors with a clear sense of the project's basic feasibility, the general economics, and the required capital expenditure to build it.
And they expect improvement later.
They also mentioned that they expect optimization during the pilot plant phase could potentially improve the project's economics relative to those initial PEA numbers.
Yeah.
So, room for upside.
And they circled back again on that unique role of the coal byproduct in the economics.
Yes, they really reinforced that point. The sale of roughly 2 million tons per year of thermal coal provides a significant revenue stream that directly lowers the REE mining cost basis, making the whole thing potentially much cheaper than it looks at first glance.
They also cautioned about REE prices.
Yeah, they highlighted the inherent volatility of rare earth element market prices, noting that published prices can sometimes be unreliable due to China's dominant market control and those export bans creating artificial scarcity or uncertainty. So pricing is a key variable to watch.
Okay, so summing up the core story presented in this call, what's the overall context for someone following Ramaco Resources now? What's the big picture?
I think you have a company that's demonstrating pretty strong operational strength and financial stability as it navigates a really challenging cyclical metallurgical coal market.
Right, managing the core business.
Exactly. Controlling costs effectively, adjusting production and sales strategically to weather the downturn, while positioning themselves with significant operating leverage for an eventual market recovery.
Okay, part one.
Part two, layered right on top of this, is this potentially transformative critical minerals project. It addresses a clear strategic national need. They've laid out a clear timeline, and it has these unique deposit characteristics like the byproduct coal economics and that focus on critical, currently restricted elements.
So how do the specifics we discussed today tie into potential investor considerations? What should people be thinking about?
Well, the cost controls and the strong balance sheet, they highlight the company's resilience in the current weak market. That's key for just surviving the cycle, right?
Absolutely. Table stakes.
Then, the Critical Minerals Project details the unique deposit, those specific high-value elements, the clear timeline with mining starting now, pilot soon, commercial by 2028, the domestic focus, and then potentially advantageous byproduct coal model that all represents a distinct long-term upside opportunity that's largely uncorrelated to the met coal cycle itself.
And the people involved.
Right. The addition of key leadership like Wallachuk and a board member like Manchin with deep, relevant experience adds a layer of confidence, or at least intended confidence, in their ability to actually execute on this very complex project.
And the external factors.
And understanding the broader macro trends is important too. In both met coal, things like supply cuts, China policies, European demand, and in critical minerals like China's dominance, strategic supply needs, pricing volatility helps frame the potential tailwinds and headwinds for both parts of their business.
So it really is a story of managing the current challenges in a traditional cyclical business while simultaneously building out a completely new high-potential venture for the future.
Exactly. The Ramaco Resources story coming out of this call is very much one of dual-engine potential. There are undeniable near-term challenges in the core business, no doubt, but there's also significant long-term ambition and real momentum behind this distinct critical minerals opportunity.
Okay, fascinating picture. Let's move into a segment now that is purely for speculative discussion. This is absolutely not financial advice. Let me repeat that. Not financial advice.
Definitely not. Just brainstorming.
This is just a thought experiment, kicking around interesting but perhaps unconventional possibilities based only on the information presented in the call we just discussed.
A chance to think outside the box a little, based on what we just unpacked.
Right. So based purely on what was discussed in this Ramaco Resources call, here's one slightly outrageous but plausible trade idea to ponder. Considering buying shares of Ramaco Resources, Inc. as a long-term investment play focused almost entirely on the critical minerals potential, essentially choosing to look past the cyclical noise and current weakness in the metallurgical coal business.
Okay, that does sound a bit outrageous given the current state of the coal market and its impact on their earnings right now. Why might someone even consider such a focused long-term bet like that? What's the justification from the call?
The justification, drawing directly from the call content, goes something like this. The Brook Mine project is presented as potentially a massive, unique, and strategically vital domestic deposit. Full stop.
Okay.
It contains those elements that are explicitly subject to China's recent export bans, making it highly relevant on a national strategic level. That could attract attention or support down the line.
Right, the strategic angle.
The company appears to be moving with real conviction, and a clear timeline. Mining starts literally this month. The pilot plant is coming soon, and they're aiming for a commercial plant by 2028. That's concrete action.
They're not just talking about it.
Exactly. They highlighted experienced partners like Fluor designing the process. They've secured some initial funding via that grant, and they've brought in key personnel like Mike Wallachuk to run the project and Joe Manchin to the board, which lends credibility to their execution plan.
The team and partners aspect.
And then there's that crucial byproduct coal sale. It significantly lowers the potential critical mineral mining cost basis, potentially making the economics very compelling if the project succeeds at scale and if R&E prices cooperate.
Okay, so the underlying thesis is that the market, which is currently, understandably, preoccupied with the well-known volatility of the met coal cycle and Ramaco's near-term earnings hits from low prices, is potentially overlooking or significantly undervaluing the long-term potential of this distinct, maybe high-margin, strategically vital critical minerals business line that is still, years away from full production and cash flow.
Precisely. That's the core idea. The outrageous part, of course, is that this requires a genuinely multi-year horizon. Patience is key.
Definitely not a short-term trade.
No way. You'd need to have significant faith in the economics that will be presented in the PEA, which, remember, is not even out yet. It could disappoint. You'd need to believe they can successfully navigate the very real technical challenges of scaling up from lab testing to a pilot plant, and then to a full commercial-scale processing facility for a complex ore body. That's never easy.
Execution risk is high.
High execution risk. And you'd need to assume a favorable rare earth element market and pricing structure will actually exist in 2028 and beyond, despite the current price volatility and China's continued dominant market control, which could change at any time.
A lot of ifs.
A lot of ifs. It's fundamentally a debt on the successful execution of a complex multi-year mining and processing project years before the cash flow is actually visible or proven.
It's a pure optionality play, really. A bet on future value creation driven by strategic assets and successful execution, rather than a bet on the near-term recovery of their existing core business.
Exactly. Again, purely speculative discussion, just thinking about the different angles this call presents. Definitely not investment advice.
And that disclaimer applies to everything we've discussed today, of course.
Absolutely. So to quickly recap the whole thing, this Ramaco Resources call showed a company effectively navigating a weak metallurgical coal market by maintaining strong operational control and balance sheet strength. That's the present.
Managing the cycle.
Simultaneously, they detailed significant progress and a lot of excitement around their potentially transformative critical minerals project at the Brook Mine, which has these unique characteristics and clear strategic relevance. That's the future potential.
It's really a story of balancing those immediate challenges with some very ambitious long-term growth plans.
Indeed. Something to keep in mind as you process this information. And perhaps, look forward to that upcoming separate call they mentioned, dedicated specifically to the details of the critical minerals PEA. That should add a lot more color.
Yeah, that PEA will be a key.
There's certainly a lot packed into the Ramaco story right now. After hearing all this, what parts of Ramaco's dual strategy managing the coal cycle while building this new critical minerals business stand out most to you? Something to think about.